So the newer it is, the higher the multiple. And let's say in our example, we've got some 7-year-old equipment. You can see that affected our multiple a little bit. And the next two numbers we need are both have to do with the lease. And the first one is the rent amount. So we need to know how much our rent is. So let's say in our example, it's $3,000 a month. Now, is this a good rent amount? Is this a bad rent amount? How do we know? Well, the way we need to look at it is the rent amount as a percentage of the gross income. So you can see that our $3,000 rent is about 20% of our $15,000 estimated income. Obviously, these are a lot of round numbers, but 20%. So is that good? Is that bad? Well, the magic number we're looking for is 25% of the gross income or less for the rent amount. However, this is just our base rent amount. Leases usually, not always, but usually have one of two other expenses. One is the common area maintenance expense. The other one they may have is a triple net expense. Usually it's going to be one or the other. And triple net expense is just that the tenants of a property will pay the expenses for the property in addition to their own expenses, okay? And the three net expenses of the triple net expense is the property maintenance, the property taxes, and the property insurance, okay? So let's say in our example, that comes out to $1,000 a month. So that brings our total rent amount to $4,000, which you can see is above our magic number.